Okay, let's unpack this. If there is one topic, one single thing that unites pretty much every person who listens to this, it's the pursuit of financial freedom.
Mm-hmm.
We all want to get to that point where our money is working for us, right?
Mhm.
Not the other way around. But when most people talk about financial independence or, FI, they immediately jump to the numbers.
Always to the numbers, the spreadsheets, the market returns, the magic number they think they need to hit.
Exactly.
And that focus, that obsession with the numbers is precisely why so many people get stuck. While the math is obviously non-negotiable, the source material we dove into for this deep dive, it reveals something far more complex.
And more surprising, I thought.
Oh, absolutely. FI is, first and foremost, a psychological and a behavioral state. And it's built on these internal frameworks that were developed long, long before you ever opened your first brokerage account.
Yeah, we're looking at an incredible stack of sources here. It's a really deep and detailed overview covering, everything from the technical definitions of FI and the famous 4% rule to some really sophisticated psychological frameworks.
Things like Bowen's family systems theory.
Right, and the whole complex world of behavioral finance.
So our mission today is, I think, transformative. We want to move beyond that traditional concept of retirement, which, let's be honest, often feels like this constraint based on your age or when Social Security kicks in.
It feels like an endpoint.
It does. And we want to understand FI as a dynamic state, a state of choice and purpose. We're going to show you, the listener, that the factors that really dictate your success are often these surprising internal dynamics.
Like unexamined biases.
Unexamined biases, deeply rooted childhood experiences, things that are just as important, if not more important, than your savings rate.
Exactly. We're decoding financial independence to show that it is truly behavioral and psychological before it is ever mathematical. Let's start, though, by making sure we all agree on the foundational language.
Good idea.
Because the devil is always in the definition, right?
Right. So what is the precise technical definition of financial independence?
Well, it's simply the state where an individual or a household has accumulated sufficient financial resources to cover their living expenses.
Without having to work.
Without having to depend on active, earned employment to maintain their current, and this is the key part, their desired lifestyle.
And when you say financial resources, that term is incredibly broad, which I think is really important. We aren't just talking about, a balanced index fund portfolio, are we?
Not at all, no. The sources we looked at, they outline that these resources can take so many different forms, and a healthy FI plan actually relies on diversification across these types of resources.
So what we're talking about, it includes the traditional investment assets, of course, your stocks and bonds, but also personal use assets like a paid-off primary residence, which reduces your expenses.
Which is a huge one.
Huge. Then you have passive income streams, rental income, maybe income from side jobs that require, minimal time. Even things like expected inheritance, pension income, and other retirement sources.
So it's the whole picture.
It's the total aggregate of all non-active employment wealth streams that contribute to covering your required monthly nut.
This brings us to what I think is the crucial distinction. It's why the FAI movement has such resonance. It's so much more than just raw wealth accumulation.
Oh, absolutely.
Our sources, they all emphasize that this state is defined by the freedom it grants you. The freedom to pursue life's goals, your dreams, your deepest purpose. It is fundamentally about optimizing your time.
And decoupling. Decoupling your essential needs from the necessity of labor. It represents a genuine transformation in your life's entire operating system. Well, it's about coming to terms with having accumulated enough. And that concept, just the word enough, is surprisingly difficult for high achievers.
I can imagine.
It means being freed from the shackles of consumer debt and overcoming that persistent human tendency to make poor, emotionally driven financial decisions. The essential transformation is that your relationship with money, it shifts.
From what to what?
From a source of stress and obligation to a tool for strategic living.
So, okay, we need to be really clear on a common misunderstanding here. Financial independence is not the same thing as not having to work at all. And this is a subtle, but I think a profound difference.
It is the difference between being forced and choosing. That's it. The freedom FI grants is the freedom of choice. It means if you choose to take a year off to go volunteer, you can.
Right.
If you choose to start a business with let's say, a high chance of failure, but it has tremendous personal meaning for you, you can afford to take that risk. If you choose to work only 4 hours a week on some passion project that makes almost no money, you can do that. Why? because your baseline living expenses are covered elsewhere. That optionality, that sovereignty over your own time, that is the core essence of choice.
What's fascinating, though, is just how subjective this goal is based on that lifestyle definition we talked about. FI looks radically different for different people.
It's entirely subjective. A $50,000 annual expense budget requires a far, far different asset pool than a $200,000 budget.
Of course.
And the source material, it contrasts two major approaches to this number. On one end, you have individuals who are striving for what's called lean FI.
Lean FI.
Yeah, they accumulate just enough assets to lead a modest, necessities-covered lifestyle, maybe in a low cost of living area. But then on the other end, you have those aiming for fat FI.
Right, the opposite end of the spectrum.
Completely. A much higher level of financial independence, specifically so they can afford substantial luxuries, increased consumption, and a much higher standard of living, perhaps in, a major city like New York or London.
And both are achieving independence.
Exactly. But the target wealth accumulation is, it's orders of magnitude apart.
And you simply cannot discuss the subjectivity of the FI target number without diving into the most visible and I think sometimes controversial example of this.
The FIRE movement.
The FIRE movement. Financial independence, retire early.
Yeah, the FIRE movement is really the visible manifestation of this whole philosophy, and it's driven by some pretty aggressive behavioral shifts. These are individuals who intentionally practice extreme frugality.
We're talking saving huge percentages of their income.
Huge. They commit to saving and investing a very large percentage of their active income, often upwards of 50, 60, sometimes even higher. And they do this to compress the traditional working career down to maybe 10 to 15 years. They achieve FI much, much earlier than the traditional timeline would suggest, sometimes in their 30s or early 40s.
So it's a contrast of speed.
Speed and intense sacrifice, yeah. It's that versus the more gradual accumulation path of, traditional retirement savers.
But whether you're aiming for lean FIRE in your 40s or a more traditional FI in your 60s, you still need a starting line. You need a clear map.
You have to know your number.
You have to know your current spending before you can even begin to calculate your freedom number.
And that's where the foundational tool comes in, the financial plan and the budget. Our sources emphasize that this is, it's not optional. It provides the critical, objective, clear view of your current income and, most importantly, your expenses.
Your burn rate.
Your burn rate, exactly. Only by knowing that can you identify and choose the right strategies, optimize your spending, and set a realistic target for financial independence. If you don't track your outflow, you are relying on guesswork.
And guesswork is the enemy of this whole idea.
It's antithetical to calculated freedom.
Okay, here's where it gets really interesting. This is where we move beyond the spreadsheets and, the simple math. The core belief we often hold is that success in FI is purely about external factors.
Right, like market timing or your salary or just getting lucky.
Exactly. But our research today, it highlights the pivotal, almost deterministic role of behavior. And that, surprisingly, often starts in the way you were raised.
We are now moving deeply into financial psychology. And researchers, they posit that early childhood experiences with money play an absolutely pivotal role in shaping an individual's fundamental values.
And their attitudes.
Their emotional attitudes toward risk and ultimately their financial behavior as adults. Parents, whether they realize it or not, are actively engaged in what's known as family financial socialization.
I find the methodology around this particularly illuminating. Researchers aren't just speculating here. They have tested methods of family financial socialization.
How do they do that? Specifically, by studying how young adults remember their parents teaching them about saving, spending, and debt when they were growing up. The key research question is whether that early teaching, contributes positively to their overall financial well-being later.
And the findings are really clear about what constitutes effective socialization. They identified specific factors that significantly improve the ability of young adults to achieve financial independence.
And these go beyond just getting an inheritance.
Oh, way beyond that. They include attaining higher education, having a stable income, owning assets, and, crucially, possessing strong fundamental money management and financial problem-solving skills.
They're all connected.
They're all interconnected elements. You need the practical knowledge, the skill, alongside the assets, the means, and the mental ability, the discipline to pull it all together.
This connects directly to a really powerful psychological framework I saw in the sources, identity capital theory. This seems to be the bridge between just, knowing how to budget and actually executing a complex FI strategy. That's a great way to put it. Identity capital theory suggests that young adults manage money better and achieve FI later in life if they successfully develop and use two types of resources.
Okay, what's the first one?
First, the accessible external resources. They call them physical resources. This means objective things like comprehensive money knowledge, financial literacy, and social connections that provide opportunities.
That makes sense. I mean, knowing the rules of the game helps you win.
Precisely. But the second resource is the key. It's the internal, the psychological resource.
Which is?
It is the ability to take responsibility for their actions and make their own independent financial decisions.
So it's about maturity.
It's the blending of knowing how the systems work and having the internal maturity, the confidence, and the self-reliance to execute a long-term plan without needing constant validation or, relying on parental bailouts.
Yeah.
Without that inner sense of responsibility, the knowledge itself is it's inert.
So what we're really seeing is that FI isn't just about the dollar amount in the bank. It's about the inner scaffolding, the values, the resilience, the decision-making framework that you carry with you. And this takes us into some deeper psychological perspectives, specifically how unresolved family dynamics and conflicts can actively derail financial success decades later.
This is where we introduce the profound, and I have to say sometimes disruptive insights of Bowen's family systems theory.
Specifically, the concept of triangles.
The concept of triangles, exactly. This theory posits that when anxiety is high between two people, say a married couple, they will instinctively draw a third person into the conflict to diffuse the tension. And this emotional triangle has profound financial implications.
Okay, give us a concrete example of this financial triangle in action from the source material. I think this is fascinating.
Okay, imagine this scenario. An elderly couple, let's call them the Smiths, they've accumulated insurmountable credit card and medical debt in their retirement. They're anxious, they're ashamed, and they cannot agree on how to pay it off.
So there's high tension.
Extremely high tension. One wants to sell the house, the other wants to leverage their retirement accounts. The anxiety between them is just unbearable. So what do? They turn to their adult child for help.
And what does help look like?
It could be asking the child to manage their finances, or worse, co-sign a new loan, or simply take on a major monthly payment for them.
And the adult child, motivated by love or maybe guilt, gets drawn right into that conflict.
Exactly. And the source material notes that this creation of a triangle, the two conflicted parents and the now involved adult child, can lead to these unresolved issues that actively derail the child's own financial independence plan.
How does that happen?
The child's savings rate plummets. The focus shifts from their own goals to managing this inherited debt stress, and the emotional entanglement becomes a systemic failure, not just a personal one. The child is financially hobbled by their parents' emotional imbalance.
Wow, that's a heavy concept.
Yeah.
So you're saying your parents' inability to emotionally resolve their own financial failures could, through this emotional involvement, literally destroy your financial independence plans.
Yes.
Even though you're not the one who incurred the original debt.
It is the legacy of unresolved issues and a lack of clear financial boundaries. And another closely related concept from the sources is the family projection process.
Okay, what's that?
It explains how children can develop these deeply ingrained emotional issues simply by witnessing their parents' toxic or anxious relationship. So if that toxicity is centered around constant dramatic arguments about money,
Which it so often does.
so often, well, those emotional issues then connect directly to the child's adult money attitudes like fear or avoidance or obsessive control.
And these early attitudes, they lead straight into conflict later in life, often in the most important relationship of all, marriage.
They do. Financial socialization theory and communication privacy management theory both illustrate how those feelings and deeply held attitudes about money developed and influenced by family in early childhood often lead to significant marital conflicts later on.
So the argument today isn't really about the utility bill.
Never. It's about the deep-seated fear of scarcity or the resentment of financial control that was programmed into you 20 years ago. Money conflict is almost always a proxy war for emotional conflict.
This psychological groundwork is just so vital. If we acknowledge that money feelings are rooted in our childhood and our family dynamics, it makes perfect sense that we aren't always rational when we invest or plan for the future.
Not at all.
We're guided by fear, by habit, by emotion.
And that irrationality is the core governing idea behind what's called behavior portfolio theory. This theory posits that investors are normal,
Meaning human.
meaning human, exactly, We're influenced by powerful cognitive and emotional biases, and therefore we cannot always make purely rational, optimal decisions based on mathematical models. We aim for comfort and security, not just maximizing utility.
This leads straight into one of the most famous and foundational concepts in behavioral economics, prospect theory. What does this tell us about our innate human nature when it comes to wealth?
Prospect theory, which was pioneered by Kahneman and Tversky, teaches us that individuals value gains and losses differently. And the core finding is a concept called loss aversion.
Loss aversion.
Empirical research shows that the pain of experiencing a loss of, say, $1,000 is significantly more intense psychologically than the joy or satisfaction of gaining $1,000.
I've heard it's like a 2-to-1 ratio or something.
Many studies suggest the psychological impact of a loss is 2 to 2.5 times greater than an equivalent gain. And this asymmetry in our feelings, it drives profoundly irrational decisions in the markets.
And we see this play out in investor behavior constantly, undermining these long-term FI strategies. Can you give us a detailed, practical example of how that 2.5 times pain factor manifests in real investment choices?
Certainly. Take an investor who is highly loss averse. In a moment of market stress, they might see their stock portfolio drop, say, 15%. Now, a purely rational decision might be to rebalance or maybe sell the losers to harvest tax losses or even double down on their high-conviction assets.
But that's not what they do.
That's not what the loss-averse investor does. They hold on to the losing assets for long periods, sometimes years, hoping they will just get back to even.
Why?
Simply to avoid the emotional realization of the loss. That emotional cost prevents them from selling and investing the capital somewhere else, which might be a far more financially sound decision. They are sacrificing future compounding for present emotional comfort.
That is the perfect illustration of emotion overruling mathematics. But loss aversion is just one piece of the puzzle, right? Our sources list a whole series of cognitive and emotional biases and heuristics that influence our decisions.
A whole catalog of them.
Yeah, and they often work against the disciplined long-term strategy required for FI. So instead of listing every single one, let's focus deeply on the ones that most actively derail the long-term plan.
That's wise because understanding the mechanism of just a few of these biases can save you years of missteps.
Okay, let's look at recency bias. This feels particularly dangerous for new investors who jump into the market based on, very limited history.
Recency bias is the tendency to overweight the most recent information when making decisions, assuming that current trends will continue indefinitely.
And for an investor pursuing SI, that's catastrophic.
It is. If the S&P 500 has been surging for 3 years straight, a new investor might assume passive index investing is too slow. They might aggressively shift their asset allocation entirely into high-growth, high-risk sector stocks, ignoring the necessity of fixed income or diversification.
They're chasing return.
They're chasing returns. They overweight the recent past, and they dismiss the historical context that shows markets cycle drastically. They ignore the long-term plan in favor of the hot hand.
And often, recency bias feeds directly into herd mentality.
Absolutely. They go hand in hand. Herd mentality is the bias where an investor mimics the trades and behaviors of other investors, often fueled by the hope of making huge profits or, more simply, the fear of missing out.
FOMO.
FOMO, yeah. They assume the group, whether it's online forums or the financial news, knows something they don't. This is a key driver of market bubbles, where assets become grossly overvalued based purely on excitement and collective behavior, not underlying fundamentals.
Which is the polar opposite of a disciplined FI plan.
The exact opposite.
Okay, now let's move to one that affects self-assessment and long-term learning. Confirmation bias.
Confirmation bias is arguably one of the most insidious biases out there. It's the tendency to search for, interpret, favor, and recall information in a way that confirms your pre-existing beliefs or hypotheses,
while ignoring anything that contradicts it.
Simultaneously ignoring or discounting contradictory evidence, yes. So if an investor believes a specific stock or asset class, say gold, is set to outperform for the next decade, they will only consume news articles, research reports, or commentary that supports that bullish case.
And any negative report.
It's dismissed as misinformed or fake news or whatever.
And if you are only confirming what you already believe, you can never adapt your strategy when the market conditions objectively change.
Precisely. It locks you into a failure spiral. If the foundational premise of your FI plan, for example, that your specific real estate market will perpetually appreciate at 8% a year is being challenged by data, confirmation bias makes it psychologically impossible to recognize the flaw and adjust the plan.
Okay, and finally, let's address anchoring. This feels like a key mechanism for holding on to suboptimal investment choices.
It is. Anchoring occurs when individuals rely too heavily on the first piece of information offered, the anchor, when making decisions.
So, like the price you bought it at.
That's the most common one, the purchase price. But it could be the initial analyst target price, a friend's prediction, or even the stock's all-time high. For example, if you bought a stock at $100 and it drops to $50, you might refuse to sell, not because of its future potential, but because you are anchored to that $100 original price.
Right.
The gap between the current reality, $50, and the emotional anchor, $100, feels too large, and it prevents the rational action of selling to reinvest that capital somewhere else.
This incredible inventory of our human wiring, loss aversion, recency, confirmation, anchoring, it just shows how the very way we process information can actively sabotage the disciplined, long-term pursuit of financial independence.
It's a minefield.
It is. We've established that the psychological challenges are real and often deep-seated, sometimes dating all the way back to the emotional handling of money in our childhood homes. So, what are the solutions? What do the sources say on the behavioral and psychological front?
The sources outline two critical solutions, and which one you use depends entirely on the root cause of the financial misalignment.
Okay.
If the issue stems from deeply rooted emotional issues, feelings of shame, anxiety, or ongoing interfamily conflicts about money, which often trace back to those early childhood experiences and potential family triangles, the solution is professional emotional support. They may benefit significantly from working with a financial therapist.
A financial therapist. So they address the root relationship with money, the feelings, the communication patterns.
Exactly. Their goal is to identify and treat the emotional and behavioral disorders related to money management. This is distinct from, and often complementary to, the second solution.
And if the issue is more structural, a lack of a plan, a lack of discipline, or just a failure to understand the investment principles needed to sustain FI.
Then the solution is a financial planner. A planner helps create the essential structure and the external accountability. Their role is mechanical and strategic.
What do they do?
Establishing a clear financial plan, assisting with goal setting, structuring a budget that actually sticks, developing consistent investing strategies, and ensuring appropriate diversification. Their role is to provide the external structure required to help individuals stay the course and mitigate the impact of those cognitive biases we just listed.
So they're like the rational brake.
They are the rational brake when emotion tries to take over the driver's seat.
This is a critical narrative bridge we need to cross. The biases we just spent so much time on are the biggest long-term threat to the math we are about to discuss.
Yes.
If the 4% rule is the engine of financial independence, the psychological biases are the engine failures. We need to look at how confirmation bias prevents you from recognizing when your initial withdrawal strategy is failing.
Or how loss aversion might make you refuse to rebalance your portfolio when it's structurally necessary.
Exactly. The behavioral reality underpins the mechanical success. So now that we understand the internal constraints, we can pivot back to the external mechanics.
Where the money comes from once FI is achieved and how that magic calculation, the 4% rule, actually works.
When discussing the mechanics of FI, we first have to categorize income. The source material focused on the context of the United States, and it's clear that achieving FI requires shifting your reliance away from the first category and maximizing the other two.
Right. So first you have active income. This is what most people earn through labor. Wages, salaries, commissions, and any income derived from material participation in a trade or business.
Basically, if you stop, the money stops.
If you must show up, put in the time, and be actively involved in the work, if the income stops when you stop, it is active income.
And this is the fuel for the accumulation phase of the FI journey. But it's not the source of income in the independent phase. That is covered by portfolio income.
Yes, portfolio income is really the bedrock of long-term wealth accumulation and sustenance. This includes interest earned from bonds or deposits, dividends from stocks and mutual funds, royalties from non-operative assets, annuities, and of course capital gains generated from selling appreciating investments.
And this income is generated from your paper assets.
It is, and it requires minimal or no ongoing labor.
And finally, the most sought-after category, passive income.
Ah, passive income. It's generally defined as income derived from rental activities or any other trade or business activity where the individual does not materially participate.
What does that mean, not materially participate?
It means they spend less than a statutory number of hours working on it, or they hire management to run it entirely. You own the asset generates cash flow, but you are not actively running the operation day to day.
So the overarching strategy is to tap into both of these latter two categories.
Yes, strategically tapping into multiple sources of income across both portfolio and passive categories to satisfy your financial needs and maintain your desired lifestyle indefinitely.
To give the listener a clearer picture of that diversification, let's run through some of the specific examples the sources provided for generating these sustained streams. We're moving beyond just stocks.
Right. The diversification list is pretty extensive. Beyond traditional stocks and bonds, it includes investments like bank fixed deposits and monthly income schemes. It also includes business ownership.
But there's a huge asterisk on that one.
A huge one. Crucially, only if the business is fully systemized and does not require the founder's active operation. This requires significant upfront active work, but it results in long-term passive income.
What about physical or unique assets?
Well, we look at real assets such as rental property income, which falls under the passive category if you have it managed externally. For those with unique assets or, older wealth structures, you might see income from things like life annuities or royalties from creative works.
Like books or music?
Photographs, books, music, patents, yeah. And then you have specialized real estate instruments like oil leases or trust deeds. The main principle remains the same, though. The income generation must be decoupled from your personal recurring time and effort.
Now we arrive at the foundational metric used by almost everyone pursuing financial freedom, the 4% withdrawal rule. This is the metric that transforms a lump sum of accumulated wealth into a viable long-term income stream.
It's where the math gets serious.
It is.
This rule is essential because it provides a conservative estimate of your portfolio's longevity. It is based on comprehensive historical research, most notably the work of William Bengen, and then later affirmed by the famous Trinity study.
And what do they look at?
They looked at historical market data stretching back decades to determine a safe withdrawal rate that wouldn't deplete the principal over a standard retirement period, which is usually defined as 30 years.
And what did that research conclude?
It concluded that an individual can safely withdraw 4% of their total portfolio savings in the first year of retirement, and then, crucially, adjust that withdrawal amount upward by the rate of inflation in subsequent years.
And it held up.
The historical success rate, even through major downturns like the Great Depression and the 2008 crisis, was surprisingly high, around 95% over a 30-year span, provided the portfolio maintained a relatively balanced mix of stocks and bonds.
So the simple application of the rule is that if that initial 4% withdrawal covers your calculated annual expenses, you are assumed to have achieved financial independence.
Right. You take your desired annual expenses and you multiply that number by 25 to get your target FI accumulation number.
That's the core metric. However, for you, the listener, we have to emphasize the limitations and the behavioral implications of relying on the 4% rule. It is a historical benchmark, not a guarantee.
That is such an important point. And the biggest threat to the rule isn't just a market crash. It's something called the sequence of returns risk.
Sequence of returns risk. That sounds complicated, but it's actually terrifyingly simple in its outcome, isn't it?
It is terrifying because it's all about timing. This risk refers to the possibility of experiencing poor investment returns early in your retirement, especially within the first 5 to 10 years.
Why then?
Because that's when your portfolio balance is at its highest and your withdrawals represent a higher percentage of the total assets. If you withdraw 4% in year 1 and the market drops 30% in year 2, your subsequent withdrawal, even adjusted for inflation, just decimates your principal base.
Making it really hard to recover.
It makes it extremely difficult for the portfolio to recover and sustain itself over the full 30-year period.
So FI is achieved when your generated income meets your needs from sources other than your primary occupation, regardless of your age or your current salary.
It's a cash flow calculation, not a net worth celebration.
Exactly. The sources provide two extremely useful contrasting examples to highlight this distinction between wealth and independence. Let's start with the operational freedom example.
Okay. A 25-year-old has very low monthly expenses, say $1,000. If they have systematically invested and acquired assets, perhaps a small dividend portfolio and a partial rental property, that now generate $1,000 or more per month.
They're financially independent.
They have achieved financial independence even if their overall net worth seems modest to an outsider. They have achieved the state of choice.
Now, the counterexample,
Yeah.
the infamous high earner trap, which links right back to those psychological biases of status and consumption we talked about.
Yes. So consider a 50-year-old who has assets that generate $1 million a month in gross income. That's staggering wealth.
$1 million a month.
$1 million a month. However, if that person's lifestyle inflation, driven by ego, status, competitive consumption, has caused their total expenses, including multiple mortgages, jets, large staff payrolls, to equal more than $1 million per month.
They are not financially independent.
They are definitively not financially independent.
They still have to actively earn the difference or maintain their high-paying job, even with $1 million flowing in monthly.
Exactly. They are running on a treadmill regardless of the large numbers involved because their expenses exceed their passive and portfolio income. This makes the distinction crystal clear.
FI is a state of surplus cash flow.
Surplus cash flow relative to needs, not just absolute wealth. And maintaining that surplus cash flow across decades requires constantly battling the invisible enemy, inflation.
Inflation is the hidden decay that must be thoroughly understood to maintain a successful FI plan.
It is. Inflation is the systematic erosion of purchasing power, and it has to be factored into the 4% withdrawal calculation. If your portfolio doesn't grow enough to cover both your withdrawals and the inflation adjustment, you risk running out of money.
Can you walk us through the calculation example provided? I think it really drives home the compounding impact of inflation on a long-term budget.
Sure, let's use a simple baseline. If a person needs $100 per month for living expenses today, and we assume a modest annual inflation rate of, say, 5%, they will need $100 per month next year to afford the exact same lifestyle.
Simple enough.
That is simple inflation.
But inflation compounds.
It does, and that's the insidious part. The following year, they don't just need another $5, they need $110.25 per month because the 5% inflation is applied to the new inflated cost base of $105.
And over decades.
Over decades, this relentless compounding upward pressure means that the $40,000 you needed annually in year one might become $80,000 needed annually by year 25.
Wow.
This is why the 4% rule relies on a portfolio that is sufficiently invested in equities to target growth that consistently outpaces both the withdrawal rate and the compounding effects of inflation.
This brings us to the final synthesized action steps. The practical strategies derived from all our source material to help someone on their journey to FI. It's the blending of that behavioral discipline and mechanical application.
The mechanical strategies are consistent, but their execution requires continuous behavioral resilience. First, aggressively increasing your savings and reducing non-essential expenses. This directly tackles lifestyle inflation.
Okay.
Second, consistent long-term investing using a structured plan to avoid the pitfalls of market timing, which is almost always driven by recency bias. And third, having a well-diversified portfolio that is appropriate for your timeline to mitigate that sequence of returns risk.
And underpinning all of those strategies are the two fundamental definitions that create the net worth equation. We need to be clear on what we own and what we owe.
Exactly. An asset is defined simply as anything of value that a person owns. They can be classified as productive, meaning they generate income, or personal use, like a car.
And a liability.
A liability is what the person owes. Any obligation to pay a creditor, such as a mortgage, student loans, or credit card debt.
So FI is a two-pronged attack.
It's the simultaneous process of aggressively maximizing assets that generate portfolio and passive income, while simultaneously minimizing liabilities, especially those high-interest, non-productive ones that just drain capital that could otherwise be compounding.
So what does this all mean? We started this deep dive talking about money and numbers, but we have established that the journey to financial independence is far more about self-knowledge, behavioral control, and family dynamics than it is about mastering an Excel sheet. We have established that financial independence is a highly calculated form of freedom, but that calculation is anchored in understanding your own psychological weaknesses and rigorous external planning.
We've seen that the mechanical strategies, the 4% rule, income classification, diversification are essential, proven frameworks. But those frameworks, they're fragile. They are worthless without addressing the soft skills.
Like overcoming the biases.
Overcoming psychological biases like loss aversion and confirmation bias. And critically, Recognizing that your earliest relationship with money, starting with your parents and their financial socialization, is just as important as your savings rate is today.
The journey to FI is as much about cleaning up the psychological debt you accumulated through life as it is about paying down the mortgage.
And that leads us to our final provocative thought. We spent time discussing complex, sometimes painful theories like Bowen's family systems theory and how unexamined issues can derail plans decades later by dragging you into financial conflicts that aren't even yours.
Right.
So if financial independence is truly about freedom and purpose, about ensuring money doesn't dominate your ability to choose, what emotional or cognitive biases, perhaps developed long ago by simply witnessing your family's anxiety or conflict around money, might still be unconsciously limiting your ability to take the crucial, rational, disciplined steps needed today to secure your own freedom? That's the psychological work that has to precede the financial reward.